Good morning, everybody. It is March 21st, and this is Stocks of the Week. And we're going to take a look at some stocks that can make some money for you or could lose some money for you. Going to introduce the new Stocks of the Week article and make it real easy for everybody. First off, I'm guessing that everybody's brackets are busted, so we would like to pick better stocks so you don't get busted in your portfolio too, right? Anyway, let's see what we're doing here. So the new stocks of the week, buy alerts and price updates. It's going to be a very template-based, easy to follow article going forward, rather than me trying to change the article format almost every week to basically follow the news. I want you to focus on the focus stocks that I put in here, and then I'll give you advice on every single stock for buying and selling. In any case, what is investing in stocks? Well, it's all about relative performance. This is a bell curve from Smead Capital, and it's about right. I've seen other ones that are a little different, but this is the smooth version. About 20% of your stocks in the stock market are what you'd call high performers. About 70% are about average, a little above, a little below, but nothing special in either direction. And then you have your 10% that just, are horrible. We don't really care about this 80% of the stocks. That's not what we're looking for. I have a lot of people tell me, well, I heard this, or this one looks okay. Those are stocks in here. It's not worth single stock risk to even consider anything in here that you think is in here. You should only consider buying stocks that are over here because the single stock risk, the risk that one company might fall 50% overnight, is worth it. So if you don't think a stock can really beat the heck out of the stock market, stick with ETFs. You'll get exposure to all the okay stocks in ETFs over here. And with smart industry selection and sector selection, your ETF portfolio should be above average. And you're really looking to add juice with your stock selection. So we don't want any stocks that we think are going to be over here, right? We don't want pretty good companies. We don't want pretty good stocks, or this one sounds okay, or this one's doing okay. If it's just keeping up with the market, give or take a couple points, don't buy it, because you might wake up very unhappy one day. You at least want the asymmetric upside, right? Because any stock can fall. You at least want the asymmetric upside in all of your stock picks. And given that you're only going to own 20 to 30 stocks, 40 to 50 on the very high side, and that requires that you're doing it, pretty much 30 to 40 hours a week just to keep up, right? I'm using an artificial intelligence to try to keep up, and, it's challenging. So this part of the market is your ETF portfolio, and you're trying to get it to be over here. Then your stock selection's over here. So what's the focus stock this week? I've been pounding the table on a Metis for a while now, right? Pounding the table. I don't pound the table very often. So I thought it was important that you understood that I'm doing this. The downside on the Metis is $7 or $8 a share. I think that's about as low as it can go because the institutional interest on a Metis is very, very high all of a sudden. In the last 2 quarters, a Metis institutional ownership has gone from like 30 or 40% to in the 70s right now. And it will probably be over 80% soon. So when you take a look at who owns a Metis, and we can certainly do that. AMTX. There you go. They reformat this so often. Ownership. There you go. Take a look at the institutions. Over half of the company. And then you have some big hedge funds and other big investors. Might be easier to look over on Yahoo. I don't have great grasp on what they're doing with who the holders are over on Seeking Alpha. We'll figure it out though. Top institutional holders. I told you about BlackRock. Owns about 9% of the company. That's a big deal. This company isn't in the Russell 2000. So they're not putting their money into a Russell 2000 fund. These are more selective. Same thing with State Street, Compass, right? Hedge fund and institutional investor. Alliance, Vanguard. This is the one that I think you really need to pay attention to. This is GMO. That's Jeremy Grantham's company. And this one here, Renaissance, maybe the most successful hedge fund company out there. You've got big deal companies starting to buy shares here. And pretty soon, you're going to see I think north of 90% of this company is going to be owned by institutions. I don't know if they're going to want to do a secondary offering at some point. They probably will. The stock will be higher when it happens. And at that point, it'll be to include it in the Russell 2000. So that's when you'll see certain companies say, oh, well, we have to buy it by mandate, and they're going to have to get the shares somehow. Well, if everything's already soaked up, they're going to go to a Metis and say, would you like to raise some capital? We have to add this. Happens all the time with these companies, these smaller companies. A lot of times, Exact Sciences was an example. The secondary isn't because they're out begging for money. It's because the hedge funds, ETFs, and mutual funds want the shares. So rather than going to the secondary market and bidding it up, they cut a deal with the company to just buy the shares directly. That's what's coming. So when people talk about the balance sheet over at Metis, they don't really understand the capital structure. They say, well, on the sheet here, it says this and it says that. And I get it. I get what backwards looking numbers say. The reason why you can invest well is by looking forward. Metis is going to be at least a $3 billion company based on the contracts they already have and what we saw Chevron just buy Renewable Energy Group for out of Iowa, which is straight ethanol. This company's better than ethanol. Rather than growing corn to burn it, they're taking orchards that were going to get torn down anyway, or that are getting torn down anyway, turning those into fuel. If you haven't looked at some of the things that I've written about Metis yet, and not looked at their corporate presentation, you really need to. I've got plenty in here so far. Today's, or this week's Stocks of the Week is another pretty big blurb. So pretty soon, and I'm just telling you this, I'm repeating myself from Friday. When I put out the big article on a company, that means that you had better buy it. As I dribble it in, that's for you to get to know it, start doing your reading, figure out where your level of comfort is, and whether or not it fits into your asset allocation and how much. When I put out the big article, the one that condenses all of this information, I'm going to give you 2 or 3 days, and then it's going to go to the hedge funds, because I have 2 avenues for releasing my research to the hedge funds. And I haven't been taking that income, which is substantial, but I'm going to start taking it. So as I dribble this into you, understand what my approach is and how I have to run my business. I really want you to be in a Metis. The big report's coming out in the next week or 2. It'll get released to one or the other of 2 ways that I have of getting my research to hedge funds, and then it'll become public to Seeking Alpha. I don't know. I don't remember how long their embargoes are if I release it to them, but I might not release this to Seeking Alpha right away. We'll see. Like I said, I have 2 avenues for releasing information to hedge funds for research, and one is more prestigious, but the other one pays better. Seeking Alpha actually pays better, so we'll see how I do it, but it'll be a case-by-case basis. So I know that some of you have asked for, well, just give me the big report. Just tell me everything you think. Well, remember, I'm doing my research over months and months and months and months. So I drop things in as I go. I am at the point right now with Metis where I'm telling you, you don't just need a starter position in this company. You need to have a way of getting to a full position. And for me, I've already taken the starter position and I've sold cash secured puts, which I will cover in the retirement income options portion of the show. But Metis is a stock that's going to go to $3 billion. It's trading at a little under $5 billion or $500 million right now. So it's an easy 6-bagger over the next 5 years. It'll be volatile because it's energy, and there's going to be a financing event at some point. But right now, around $10, $11 a share, there's only a couple dollars of downside and like 600% upside. And there are a few things with Metis, including India, that if India really takes off, and I expect that it will, I mean, you're looking at, a potential $5 to $10 billion company. So we'll put it that way. Somebody says, I'm not sure how much orchard waste will have. Orchard waste is massive in California for what they grow. So they have way more orchard waste available than they can use, actually. And that's why they can promise to Delta and American Air and Japan Airlines and I forget the one that they just signed. Was it Qantas? Was it the Australian company? They are going to max out their biofuel capacity, I think, by next year. So as that plant comes online in 2024, I believe it is, it's going to already have maxed out capacity. Think about that. They're building not based on spec. We're going to build this thing and see if we can get customers. No, they're saying we have customers that want us to build this thing, and they're signing contracts. If you relate that to real estate, in a hot market, people will go out and just build a house and expect, oh, I'm going to find a buyer. That didn't work out so well in 2008, right? People who built houses in 2007 were stuck. This is different. This is the same approach that Kinder Morgan has taken. We're not building a pipeline until we have contracts to fill it. Same thing that he's doing here. If you listen to the interview I did with the CEO, we talked about that. We touched on that. So they are building based on the contracts that they have in hand. And I gotta be honest, I don't see how this company doesn't make a run at being an S&P 500 company at some point. Because if India does anything, it's worth a lot more than $3 billion. And that's why you're seeing the institutional investors pile in at this point. It's rare that they get a chance to really pile in when nobody's looking. And by luck of me having a connection in California, we're getting in on this one early. So as we go through the rest of the article, I just want you to see the format. It's going to be pretty easy. I'm breaking it up into the large and mid cap growth stocks, the small cap growth stocks, the dividend payers, and then the high dividend yield stocks. And the one that I want to take a look at today is Kinder Morgan. I'll have the bottom fishing price there for you, and then any trade notes. In the next edition of this will all be filled in. But I thought this would be easier for you to follow, having the very short why am I doing it and what should you do and at what price. Super easy to follow, which I think has been a problem, is that I haven't been super easy to follow. So I'm going to make it super easy to follow, right? So take a look at end phase. If it approaches the bottom fishing, I'll buy it. Otherwise, I'll get exposure via the clean energy ETFs. Same story probably for, Alphabet and Microsoft. Alphabet and Amazon are both splitting 20 for 1. And they both, to me, have support right around $100 a share after the splits. And I'll adjust the charts when it happens. I think Amazon support's just a little bit higher. So right now, 20 for 1 on that is right around 100. 20 for 1 on that is right around 100. All right, so let's take a look at Kinder Morgan. This is a stock that every time it got into the low to middle teens, we bought it. It's been a pretty good ride since the correction. Going back 5 years, you can see that it's basically just been in a range. It is right now at the point where it might break out of that range. Will it or won't it? I don't know, but interestingly, on the options chart, and I got an alert on this, pretty big volume on the April $19 covered calls. I don't think this is covered calls, right? On the calls, I may have said covered calls a second ago. Pretty big volume on the calls. A couple reasons why. A, super cheap, right? So if you're trading this to the long side, you don't have to have it go very high to make money on this. So if Kinder Morgan goes to 20 by April, somebody's going to make 500% on their money buying these calls. It's certainly not somebody selling the call because there's no money to be made there. You're capping yourself too low. Somebody is speculating that this one's going to rally. And if it does, keep an eye on the news, because this is a stock that I think would be really attractive to a guy in Omaha. And while it's a little bit above what he's looking to spend, he generally says 20 to 30 billion. And if you notice, Berkshire just bought an insurance company for 11 billion today. I could see Berkshire reaching out and buying this. I could also see Kinder Morgan merging with Williams or another pipeline company that they could hook right into. They are the biggest transporter of carbon in the country. And what do we know about Berkshire Hathaway? They just bought a ton of Occidental, which is the biggest carbon capture company in America, right? Ametis, that little company, is getting into that too. So I'm a green guy, but I realize that we're going to need fossil fuels for quite a while. That carbon capture is going to be a huge part of the fossil fuel equation now. Government's pushing it 2 different ways, and they'll probably push harder. Now, one of the things is the caps on emissions that are not particularly capish right now. We don't really have carbon caps. But the day is coming when different financial tools will be used to punish carbon emitters. Right now, there's incentives for pulling carbon out of the atmosphere. And that's what Ametis is getting their biggest tax breaks for, biggest incentives. Kinder Morgan, Occidental, Berkshire, they're all in on that game. So we want to be very aware that that is a huge secular trend, and energy is a massive amount of the economy, even if it's not always a massive amount of the S&P 500, right? Everything runs on energy, everything. Where do I think Kinder Morgan is going? You take a look at that chart. I mean, the trend is up. Can it spike to 20 and break out? It could. If it gets into the middle 20s, we're going to have to think long and hard about what we want to do there. In the meantime, you're collecting a big fat premium. So when we go over to the stock screener at TradingView, and my crook nickels are basically the oscillators with RSI, you take a look at what's overbought on the weekly chart, and we're starting to see more overbought again. Not quite yet. I think that we can see more rally. The put to call ratios indicate that there is some coiling going on with the market, and really any good news on Ukraine before the next rate increase from the Fed, or if they really start to run off their balance sheet. I think there's a window for a rally. And I told you that in an article like 3 weeks ago, which was really right at the bottom of the market. So we're getting this little rally within what I think is an emerging bear market. And the rotations are what is making this hard. We're not getting everything down at the same time bear market. We're getting certain sectors and industries having their little mini bear markets within what is appearing to be either a developing shallow bear market, which is what I called it, or it might just be choppy, right? You might have another 2015-16 period where the market is just choppy and things get right priced sequentially rather than all at once. So we have to pay attention to what the market does and adjust. So right now, Berkshire Hathaway is overbought. So what? Right? They got a mountain of cash. Occidental is overbought, mainly because Berkshire has been buying it. Nutrien is the one I want to take a look at. So Nutrien is a company that I was writing about way back in 2013 when it was called Potash Corp. And I talked about Russia and Belarus's impact. So here we are, post-Crimea, and in the wake of Russia invading Ukraine. I don't know that I intended this to be that type of forward-looking, but it ended up being that. So way back then, Potash Corp was trading at a high of 44, and at this point it had dropped down to 32. And I talked about what their sales of potash were going to be. And back then it was 6.4 million tons in a year. Anybody know what the estimate is for this year? They just raised it to 15 million. So I had a couple articles on Motley Fool, taking a look at the global potash levels. Global potash levels have dropped to an all-time low, basically. There is only about 3 months left of fertilizer at this moment, potash in particular. So potash is in a pretty tight market, and Nutrien is doing pretty well. And yeah, there's going to be a short-term impact from a rail strike that's going on right now. So people are writing about Nutrien suddenly now that it's up a ton, right? So we bought potash, Nutrien way back here, and when it was still Potash Corp and trading in the 20s and 30s. So we've had this one a while. This is the break when it switched from being called Potash Corp to their merger with Agrium that resulted in Nutrien. And they sold SQM along the way, their lithium. So here it is all of a sudden. Look at that rally. I want you to take a look at the monthly RSI. That is extremely overbought. People are chasing this one up right now. If you're a dividend growth investor, I think you have a couple questions to ask yourself. One, do I want to hold on to this long term? If the answer is yes, and I don't think that's a bad answer, I got stopped out of it around 50 or 60. One of these jitterbugs I got shook out. That's why I don't like using stop losses. I'm missing this big rally. But I know that a lot of you still own this. So I would take a look at there it is. I would take a look at this option chart again. I would take a look at the $120 July covered calls. There's open interest there, so there's enough inventory. And you'll get about $4 for a July $120 covered call. How does that rate compare to the dividend? The dividend's $1.92 a year. So you can triple your dividend by writing a $120 July covered call and still have $15 of upside on the stock. And by then it'll be crazy overbought, right? Crazy overbought. I mean, monthly overbought is, you generally sell at that point. So what I'm telling you is at least write a covered call against half to 2/3 of your position. I'd say probably 2/3, because the odds of it going over 120 and staying there, I think, are pretty slim. There's just physical constraints, right? This isn't tech where they can pile on subscription after subscription after subscription. At some point, they just can't sell anymore. And any good news from the fertilizer industry, an end of the war in Ukraine, for example, will let some air out of this. I do think it's interesting that way back here and way back here, I was saying, when Nutrien was in the 20s, it was going to go to 100. And here we are, we're at 100. Can it go to 200? Maybe, but that's not a four-bagger anymore, right? How many of you on this call actually own Nutrien at this point? Anybody? Just curious. So when we go through this, somebody says they sold half. Somebody says they sold their position over last month. Yeah. So anyway, we flip this over. We take a look at the oversold stocks. Zoom is starting to look super interesting, as I've talked about the last couple of weeks. PayPal, we already sold puts on. DocuSign is kind of interesting as a secondary idea. Meta, we keep track of that just because it's huge. Teladoc is interesting, right? This is where we start to look, because when our stocks get oversold on the weekly, we really want to take a look and say, okay, where are they at? Let's take a look at Zoom. Zoom got down to the buy zone, and I've lowered this a little bit. It was up here. I said way back when Zoom was in the 400 or 500s, I said it'd get down to around 200. Now it's down to 116, and it got all the way down to 100 right here. And I think that this is your jitterbug zone. Why? We'll point out the importance here. I know everybody likes their magic, so here's your magic. These bars are tracking 80% of the market. This is your institutional interest, essentially. These are your big buyers and sellers. See how the blue is bigger than the yellow? That means there's a lot of buying interest back here. So the blue represents here, and the yellow represents here. In this case, blue up price, yellow down price. Buying pressure, selling pressure. And then right here is where there's just not a lot of interest compared to up here. Why? Because the buyers weren't in yet, and the sellers start to get exhausted. So the changes in how these bars work tell you the story based on whether it was going up or down and what time frame you're looking at. So what we know is that right in here, this could have acted as support, and it didn't, because now we're in that jitterbug zone. So if you like the Zoom story, and the thing that you have to understand about Zoom is that if they do well, it's because they capture a lot of enterprise, which means that they're competing with Microsoft and Google, which also means that these guys are a takeover target for Microsoft, Google, and anybody else who wants to compete, like Oracle. So I'm always looking for, okay, if my company has a hard time executing because of financial reasons or whatever, or just a barrier to entry, is their technology good enough that some company sitting on a mountain of cash would want to buy them because they can overcome the barriers? And this is one of those companies. Either they execute and they keep dropping money to the bottom line, or a company that can use the technology and the penetration, especially to the consumer side, can gobble them up and use them. The reason that's important is because it eliminates a lot of the downside risk. If you have something that big companies want to buy, you've got two ways to win, or at least you have a way to win and a way to avoid a lot of risk. So I think Zoom is in that area. And I think when this turns over, we can take a look at it. On the weekly, it bounced up a little bit. So what we want to wait for is for this to turn down one more time. And our clue will be over here on the daily chart. So this is the daily RSI. Relative strength came up. So as this comes down on the daily, it'll pull the weekly down, just like the weekly pulls the monthly. So this is basically saying there's a little bit more downside. So if at the end of the month there's a downtick, that might be our signal to buy it or sell puts the last week of the month or the first week of next month. So I think we're within a week or two of making a move on Zoom if this keeps heading down and gets to, in the 90s or 80s again. So it gets down really close to the bottom fishing. I think you have to hold your nose in the 80s somewhere. And at a minimum, sell puts, but probably take a starter position as well. PayPal and Square, we basically bottom ticked a couple of weeks ago, right? So when I told you all to sell puts on Square and PayPal, those should have been hugely profitable trades. And if you took a starter position, and I have Square at 85, I think, I'd have to double check. You know, you got a little bounce. I know a bunch of you bought Square. So a little tangent here. I spent almost all day Saturday and Sunday between basketball breaks studying the companies that have Bitcoin on their balance sheet. And I asked Shooter, I said, why would I do that? Why would I buy companies with Bitcoin on their balance sheet just for the sake of the Bitcoin on the balance sheet? Why wouldn't I just buy Bitcoin? And he said, options. You can trade options on the stocks. So if you're a trader, that's why you buy stocks that are just completely tied to Bitcoin, like Marathon and MicroStrategy. MicroStrategy is the second or third biggest holder of Bitcoin, and they make about $100 million to $100 million a quarter they make on their regular business. It's a tech company, Michael Saylor, and he's pumping all the profits into Bitcoin. And at these prices, probably a good idea. So MicroStrategy will end up becoming a piggy bank for Bitcoin. But the way I think about this is this. If a company is strictly in business for Bitcoin, you might as well just own the Bitcoin. But if a company has strong revenues from other businesses, and they just use some of that revenue to buy Bitcoin to make their balance sheet better, then that's really interesting. So you take Square, which is like 10th on the list. I can actually pull it up. There you go. So these are the companies with Bitcoin. When you go through them, most of them are trading at a premium, significant premium to what the Bitcoin is valued at. Might as well just buy Bitcoin, unless you're trading options. But when you take a look at Tesla, they're becoming very profitable. And Square, they're very profitable. And Coinbase is borderline profitable. They've been profitable. Looks like this will be an average, a close to 0 year for them. When you look at some of the companies that have Bitcoin, but they also have a very viable main business, now it's added revenue for them because they can buy with dollars, right? They spent $130 million on Bitcoin, and now it's worth $183 million. Or Square had $220 million. They turned it into $320 million. You see the impact on their earnings. Tesla, 1.5 billion. Now it's almost 2 billion. And what if I'm right and Bitcoin goes to 500,000 in the next 4 or 5 years, right? Whole bunch of what otherwise would have just been dollars on the balance sheet. They'd be turning dollar bills into $10 bills. And they still have the free cash flow from the main business that they can decide what to do with. So I like Tesla if it ever gets low enough. Square we've been buying. And Coinbase, if I can figure out what I think the bottom on Coinbase is, Coinbase. That was one of the things I mentioned in the stocks of the week is I'm not really sure where to buy Coinbase yet. It's a hard company to value. At some point, maybe we just get an easy to navigate blow off bottom, and then there you go. But so far, Square has been the one to buy. I think we're going to be very well rewarded with Square. So in the last, month, I told you to buy Square, PayPal, and Unity. We pretty much we bottom ticked all of them. They're all tied to the metaverse. They're all tied to fintech, giant secular trends, right? Part of our process. All right. So Teladoc is the one that I look at. And I think their moat, which everybody thought was super deep, is actually pretty shallow or maybe non-existent. So I don't know where to buy Teladoc. If we got into the 50s again, I'd probably sell a put. I don't know that I'd even take a starter. I do think Teladoc is a buyout candidate. So for those of you who are real active in put selling and you have the risk tolerance for doing it with growth stocks, I think Teladoc is on that list. So if we pull up Teladoc, notice that I'm using Seeking Alpha for the options. I finally got Seeking Alpha to add this. I asked 3 years ago. You take a look at Teladoc and you say, okay, our bottom fishing price is 55. What can I sell a $55 May put for? And you're at about 350. 350, right? 3.5 divided by 55. 6% for a holding period of 8 weeks, about 6 8-week periods in the year times 6. And that's a pretty good return on your cash that's sitting in your money market account. 38% annualized. It's actually a little bit more than that, right? You saw how I kind of back of the napkin that one. So this is going to be a put that I have in the retirement income options later today, because this is our bottom fishing price, and we can get $350 basically be paid for having a limit order. What else do we have left? I think that was it all here. AST Space Mobile got just under our bottom fishing for a few weeks, and now it's rallying. I think it's going to come back down here. I don't think it'll get all the way down to here. I think about $7 a share might be the best you get it at. So this is another one that if you don't own it and it's within your risk profile to own it, there you go, $7.50, get 60-70 cents for it. Pretty good rate of return, and you basically have a limit price of $7.50. You can play it shorter term for sure. Did it not snap? $7.50 for May. Oh, that's the nearest dated one. I must have put up August. Okay, August, you're getting more. Remember the story on AST Space Mobile is if the technology works, and the signs are that it does, because they just cut a multi-satellite launch deal with SpaceX. They're going to put up a constellation in 3 different parts, but ultimately cover 90% of the planet. I think everything but the poles. So this won't work in Antarctica or the North Pole. But they're going to be able to do 5G from space. And I think it's probably not going to be as fast as terrestrial, right, as from towers. It might be a lot more like the LTE, right, the 4.5, the 4.5G that we kind of have right now out in rural areas and on mountains and on ships. And some of the telecom companies that are hooked up with them, like AT&T, suddenly become global telecom companies. So if you're an American and you're traveling and you have AT&T as a service, you don't have to buy a track phone anymore. Probably just turn it on for your trip, turn it off when you're back home. Or if you're in a rural part of America, which is most of it, the phone will switch off between towers when you're close to a road, or the satellite when you're not. Again, I don't know what the service is going to cost, but to me, it seems like a $10 a month add-on. I don't know if they can get 20, but I think everybody will pay 10 to have the overlap. I think there's even a value in the cities, right? How often are you in a spot where a 5G tower can't bend around the corner, but a signal from the sky would work just fine? So if this works, if AST Space Mobile works, they have a multi-trillion-dollar total addressable market. They're valued at $2 billion right now. Easy to see this become an S&P 500 company. Easy. I have a hard time valuing them if everything works, and because we don't know exactly what pricing would be. But if the technology works, and again, it seems like it's going to, I mean, this is just gigantic company. So only risk what you can afford to lose in case the tech doesn't work. But if it works, boy, oh boy. This is another one that can be a 10, 20, 30 bagger, I think, pretty easy over the course of the decade. And you have to decide what you can have in your portfolio. Square, PayPal, and Unity, right? They came down, they corrected, they got their valuations right, and now institutions and contrarian investors are buying it. And I would categorize myself as a contrarian investor in that I think when a good company gets beat up, that's usually sentiment of the market, and it usually has very little to do with fundamentals or a forward-looking outlook. I think it's a backward-looking outlook when a good company gets beat up. Now, of course, I would say that 4 out of 5 stocks aren't investable to begin with. So if a 1 in 5 stock gets beat up, you should really ask why and see if the market is missing something. Is it just being emotional? In the AST Space Mobile case, I think there's just a ton of uncertainty around the technology, and we won't know until we know. This is a very speculative stock, but the early signs are that it's going to work, and that makes the upside huge. So I would encourage you to figure out ways to sell puts on this one. And I know that a ton of you have starter positions already. We may do a long call option on this one at some point if we can get a pullback, because the first launch is over the summer. And if it works, then they're going to start putting up the constellation because they have the cash just sitting there waiting to do it. All right, let's call it a day. That was a long meeting, and I didn't break it up the way that I wanted to. I'm not really sure if I can break it up. We'll have to figure it out. I might have to do a split screen stocks of the week and retirement income options. We'll figure it out. The new retirement income options article will come out later today, I think after the market close, and I'll have 4 or 5 ideas in there. And that's what the retirement income options is going to be every week from now on. It's not going to try to cover everything. It's just going to be my 1 to 5 best ideas for the week, and then away we go. All right, everybody have a great day. And if your team is still in the tournament, good luck.